Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technology, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Sal Bruno, investment strategist at Nasdaq Global Indexes, and we have Alex Michalka of investment research at Wealthfront. He's the vice president, and we're here to discuss the merits of direct indexing versus ETF investing. It's great to have the both of you with us. Before we get into the conversation, Alex, give us a brief background on Wealthfront.
Sure. Thanks, Jill. It's great to be here. So thanks for having us. Who is Wealthfront? We are a technology-powered financial platform. Our goal is to help our clients, who by and large tend to be young professionals, millennial, Gen Z knowledge workers, build their long-term wealth. We are one of the first digital-only financial solutions platforms, and we're one of the pioneers in automating low-cost, diversified, passive portfolios. Since then, we've branched out, added adjacent products, for example, our high-yield cash account, stock investing, lending products, as well as some financial planning tools. So how do we help our clients grow their wealth? What we do is we take the best practices of investing, I mentioned some of these things already, low fees, tax efficient, passive, diversified, and implement them using software. And by doing that, we can deliver them in a way that delights our clients. First of all, it's low cost compared to traditional advisory. And importantly, it's through an app. Our clients don't want to go into an office and speak to a financial advisor. They actually say that they pay us not to talk to us. They like to manage their investments the same way they order a taxi or an Uber. So our app, using an app is what they like. And this approach has served us well. We've earned the trust of over 1.3 million clients and over $90 billion of their savings.
And Alex, let's discuss the merits of direct indexing versus ETF investing.
Mm-hmm. So it largely comes down to tax efficiency. ETFs are pretty tax efficient already, much more so than ETFs, who can't get around the requirement of distributing capital gains every year. We can also do tax loss harvesting using ETFs, and that's actually how most of our tax loss harvesting is done. We started doing it with ETFs about 12 years ago. We've been doing it using stocks for about a decade or so, not too much shorter. So we have a lot of experience in both, but a lot of the tax loss harvesting that we have done has been through ETFs. We've actually, over the past 10 years or so, harvested about $3.5 billion in losses. Which translates to approximately, using some assumptions, about $1 billion in taxes saved for our clients. So the way we do it with ETFs is that for every asset class where we have tax loss harvesting supported, we have a primary ETF and an alternate. So we buy the primary first, and if it goes down in price, we sell that, harvest the loss, and then buy the alternative. And the primaries and alternates, they're not identical. Obviously, they're different funds, but also they track different indices. So they're chosen so that we won't trigger what's called the wash sale rule, which if you get tripped up in that, you can nullify some of your losses. Now, ETFs, we can obviously do tax loss harvesting pretty well with ETFs, but it's sometimes the case that buying the stocks directly can be even more effective. So the reason why is that an ETF is just one security with one price, right? If you buy it and the price just goes up, then there's no tax loss harvesting to be had. Now, it's pretty rarely the case that when the market is up, every single stock is up. So that's where direct indexing comes in. With direct indexing, you're buying all the stocks directly rather than through a fund. So you get exposure to the index, but it's direct, hence the name. So where it is beneficial is when there's dispersion in the stocks that are in the index. Dispersion is just kind of a slightly fancy word of saying not everything's moving in the same direction at the same time. So that even if the market is up as a whole, some things are down, and you can tax loss harvest in those. So you kind of get the best of both worlds. Even when the market's up, you get to take advantage. You get to enjoy the advantages of that. You're making money pre-tax. But then you also get to take advantage of some dispersion, do some tax loss harvesting, and save money on taxes. There's also a second benefit of a little bit of flexibility or customizability. If you want to, you can choose to exclude some stocks from your direct indexing portfolio. Very common example that we see is people excluding the stocks of their current or former employers, where they have enough exposure already, don't need to double down on it, or just some companies that people would rather not have exposure to.
Sal, why is the Nasdaq 100 well suited for a direct indexing strategy?
So conversations that we've been having with our clients talking about the Nasdaq 100, which is basically 100 of the largest non-financial domestic and international companies that are listed on the Nasdaq Stock Exchange. The conversations are centering around how do we use the Nasdaq 100 in a portfolio, and increasingly those conversations are centered on how is the Nasdaq 100 becoming more of a core holding in portfolios. When we talk about the Nasdaq 100, we think of it as the benchmark of the 21st century. It is the benchmark of innovation. It has a healthy exposure to technology companies, but also a very healthy exposure to companies that are not technically technology companies, but are deploying technologies in their relevant industries to really help move and propel their companies forward. So significant holdings in consumer discretionary companies, healthcare, particularly in biotechnology companies. And when you look at the profile of the NASDAQ 100, it tends to have a core-like structure, but definitely more growth-oriented. It has a significant amount of overlap with the S&P 500. In fact, it's right around 50% right now, which is up significantly over the past 20 years. 20 years ago, it used to be about 15% overlap with the S&P 500. Now it's about 50% of the market capitalization in the NASDAQ 100 is also in the S&P 500. So you are getting much of the similar exposure that you would be getting through the S&P 500. But again, it has that differentiated. It's a little bit more concentrated, only 100 names instead of 500 names, and is going to have some differentiated characteristics, especially more growth-oriented style.
Yeah. And Sal, are you seeing interest across the spectrum of investors from retail to institutional?
Absolutely. It's a conversation we're having across the entire spectrum. And, especially given the performance of the NASDAQ 100, 13 out of the last 17 years, not counting 2025, the NASDAQ 100 has outperformed the S&P 500. If performance continues to hold, this could be 14 out of 18 years. We're ahead on a year-to-date basis relative to the S&P 500. So, performance gets people noticing and sort of initiates the conversation. And we're able to drill in to talk about some of the fundamental holdings, some of the key drivers of performance, some of the other characteristics in terms of lower debt to equity ratios in the NASDAQ 100 relative to the S&P 500, and some other compelling metrics. So, and that resonates very well across the spectrum, whether you're talking to retail clients or institutional clients.
Alex, let's talk about Wealthfront's NASDAQ 100 Direct. This is the first direct indexing product specifically for the NASDAQ 100 index for retail investors. Can you tell us about how the product works and what motivated the launch?
Sure. So NASDAQ 100 is really, we think of it as a more tax efficient way for retail investors to get exposure to the NASDAQ 100 index. Like you said, it's the first ever product to bring direct indexing direct to retail for this index. Like I mentioned before, direct indexing is just buying the stocks individually. But that direct ownership is key because it creates more opportunities for tax loss harvesting. And those are really valuable because they can be used to offset either capital gains that you have elsewhere in your portfolio, or if you don't have capital gains, you can use the losses to offset up to $3,000 of ordinary income each year. And another important thing to remember is that the losses roll over. You don't have to use them every year. So if you have too many losses one year, it's okay. You'll be able to, they roll over indefinitely so that you'll be able to use them in future years. Now, like Sal said, NASDAQ 100 is more concentrated and more oriented towards the newer economy, more innovative type companies. That means it's more volatile than the broad market, and the individual companies themselves are more volatile on average than individual companies in the broad market. But tax loss harvesting takes advantage of that. Sometimes the volatility becomes a feature in that there's more opportunities for tax loss harvesting. So there will be some tracking error in between the index and your portfolio that's sort of unavoidable. But that tracking error is going towards creating the tax losses that help save you money each year.
Yeah, and Alex, just to sort of drill in on that point, one of the things we look at is what does the dispersion of returns look like across some of the biggest names in the NASDAQ 100? And we focus in on the 10 largest names, and we've seen anywhere from 40 percentage points up to 60 percentage point differences just within the top 10 holdings on a year-to-date basis at different points in the year. And You think about what happened earlier in the year with the tariffs, and certain companies did very well during the tariff announcement. Companies like Netflix and Costco actually performed really well relative to the rest of the companies. Apple was actually down. They have significant manufacturing and distribution in China, and they got hit harder by the tariff announcements. Some of the semiconductor names like Broadcom and Nvidia actually didn't do quite so well in the first quarter into April as well. The semiconductors have since recovered, and now they are at the top of the leaderboard. Looking at companies again like Nvidia or Broadcom, and so you do see this rotation. A lot of people think about it as sort of a singular trade. It's a technology index, and they all move together. That couldn't be further from the truth. We see very broad dispersion, even just looking at the top 10 names where there's significant weight. So I think that prevents some really great opportunities for direct indexing and tax loss harvesting when you see that differential in return among some of the largest names.
Yeah. And Alex, who do you see using the Nasdaq 100 direct? Is it high income, high capital gains investors, or is the spectrum a bit more broad than that?
Well, that's what it's best for, really. Tax loss harvesting is really best for people who have a lot of capital gains or expect to have a lot of capital gains, either now or in the relatively near future. Also best for people that have a long-term horizon. One of the ways that tax loss harvesting works is by deferring taxes to later, not by making them disappear completely. So generally speaking, or all else equal, the longer you can defer those taxes for, the better. So it really helps to have a long-term horizon. But we have seen interest from a lot of CEOs, managers, or employees in the tech industry who could use the tax loss or the tax savings opportunities because they have stock compensation, for example. We're also seeing a lot of interest from clients who work at Nasdaq 100 companies because of that customization feature that I mentioned before. They can invest in the index, but avoid some of the over concentration in their employer stock.
Yeah, and this product, it's being offered at 12 basis points, which is less than the expense ratio of any other Nasdaq 100 ETF on the market. How is Wealthfront able to do that?
Sure. So direct indexing is not new. People have been doing it for decades. We're not the first. But historically, it's only been available through traditional advisors, which usually meant there's a higher fee or a higher minimum, often $100,000 or more. The fact is, it's more complex than having a client invested in mutual funds or ETFs. It takes more work, more oversight. And for some traditional financial advisors who have more manual processes, it just might not make sense for them economically to offer a product like this or an implementation like direct indexing to smaller accounts. At Wealthfront, we do everything with software. The portfolio management is completely automated. The tax loss harvesting part is completely automated, which we like because software doesn't get tired, it doesn't run out of hours in the day. It can check the portfolio for tax loss harvesting opportunities much more frequently than someone doing it manually might be able to. And it's not humans using this portfolio management or tax loss harvesting software. There's no one saying, okay, time to rebalance Alex's portfolio. Software is getting called by other software. Everything is just happening automatically. We try to reduce human intervention to the maximum extent possible. And that's not just in the portfolio management. All the onboarding to Wealthfront, including the risk assessment and suitability, is all done via software as well. A lot of our back office operations are fully automated. So by taking people out of the process, we're able to keep the costs low, and then we are able to keep our prices low.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.